This matrix shows how certain types of changes affect account balances. The misconception that cash accounts have credit balances results from your bank statement terminology. When you deposit money at the bank, the institution debits their cash account and creates a liability or credit on their books for your account balance. Bank statements often note that your account was credited. That's from their perspective, ultimately creating the confusion with the depositor. Let's make sure we understand the accounting principles behind depreciation. In a moment, we'll look at an example. To reflect the economic value of a large purchase to be held and used by a business beyond 1 year. If an item was charged exclusively in the single year of purchase, it could possibly materially distort your income statement. And of course, for tax reasons. If no items were capitalized, taxable income in the year of purchase would be substantially reduced. This would affect the government's cash flow. Accumulated depreciation is pretty much what it sounds like. Consider a plumber who purchases a $20,000 truck to be depreciated over 5 years. When we say that we are depreciating the purchase over 5 years, we're saying that the value of the truck will be spread over its useful life of 5 years. Therefore, the cost will also be spread over its useful life, 5 years. In this case, the depreciated amount would be $4,000 per year for 5 years, totaling $20,000 in the 5th year. On the books, the company would show the first year's depreciation of $4,000 for the truck, and not the full price of $20,000. Notice the dramatic effect on net income. In the first year, your net income would be drastically understated. In subsequent years, it would be drastically overstated. Balance sheets are affected by 2 types of transactions. As we mentioned earlier, a balance sheet is a snapshot of financial conditions at a specific moment in time. They are always stated as of a specific date. Let's go back to the hierarchy of financial reports. As we alluded to earlier, the income statement has inputs into the balance sheet. Now that we've covered the balance sheet, we can explain the income statement in more detail. For example, each and every time a plumber installs a sink, he incurs expenses. The cost of a new sink, some new tubing perhaps, his labor, and the cost to drive the installation truck to the client. Whether he installs 1 sink per month or 1,000 sinks per month, he incurs these costs. Remember, however, that under the principle of economies of scale, he may be able to reduce the cost of these variable expenses as the number of projects increase. For example, he may be able to buy 1,000 sinks from his supplier at a volume deal of $70 per sink instead of $100 per sink for individual purchases. For example, consider the cost of the plumber's personal sales office. When he pays the rent at the beginning of the month, regardless of whether he sells 1 sink or 1,000 sinks that month, the rent remains unchanged. Of course, as we indicated in the prior slide, the rent may jump in a step fashion if he needs a bigger office to store his files or equipment next month. The graph you're about to see will illustrate the relationship between time and money and their combined effect on gross profit margin. Notice that overhead costs increase in a step function. As an example, consider the overhead cost of rent. Rent is fixed for a period of time until the company requires additional space to keep up with the business's expansion. The overhead cost for space, that is, rent, would experience a sudden increase. Let's say that the company expects revenue to increase at a faster rate than variable expenses. Gross margin is derived by subtracting variable and fixed, in this case overhead, expenses from revenue. In non-mathematical terms, the gross profit margin will increase as long as the revenues increase at a faster rate than total expenses. Under normal circumstances, profit margins should increase as sales volume increases due to increased buying efficiencies. Economists refer to this trend as economies of scale. Let's take a look at a simple income statement. Start by noticing that sales increased from $100,000 to $150,000, and the direct cost of sales, that is, variable expenses, increased in proportion. In other words, individual sales costs remain unchanged. In actual dollars, overall selling expenditures increased nominally, $5,000 to $6,000. General and administrative expenses, our fixed costs, have remained the same for now at an actual dollar amount of $10,000. Bring your attention to the net income percentages. A growth in net income of 4.3% demonstrates that the business is becoming more efficient in operations. So, if individual installations still have the same variable costs, sinks, time, etc., how did we increase our net income? Let's go back to general and administrative expenses. While our actual overhead costs, like office rent, remain unchanged, they've become a smaller percentage of our sales revenue. We're conducting more sales using the same overhead resources we had before. In simple terms, we're doing more with the same. Controlling these fixed overhead costs is a daily challenge that should be shared by all departments. It is easy to say yes to increased expenditures, say, for newer computers or office furniture, but extremely difficult to roll them back and reduce them. These types of percentages are often more useful than actual dollars in gauging your business against industry averages. We hope you have enjoyed Accounting Basics for Business.